So have you ever thought about how a huge global company, one with offices in New York, Berlin, and Tokyo, manages to follow three completely different sets of financial rules all at the same time? It sounds like it should be impossible, right? Well, there's actually a super elegant solution. Today, we're going to crack the code on what's called parallel accounting. So let's set the stage here. Imagine for a second you're the CFO of a company. Your headquarters are in the US, but you've got factories in Germany and a sales office in Japan. You're one company, but legally you're forced to speak three different financial languages just to satisfy local laws. It's a total logistical nightmare. And that really gets us to the heart of the problem. How on earth can one company report its earnings according to, say, local German tax law and also report them according to international financial reporting standards for its global investors? How do you keep one single source of truth when the truth has to be told in so many different ways? Well, the answer is this brilliant method that's built right into modern financial systems. It's called parallel accounting, and believe me, it's how these massive global businesses manage all this complexity without, tearing their hair out. And honestly, the concept itself is surprisingly simple. Instead of trying to keep completely separate sets of books for each country, which would just be a disaster for data entry, you run them side by side, or in parallel, inside the very same system. It's what allows a company to become truly multilingual in the language of finance. So, to really get how this works, we need to talk about the fundamental building blocks of the whole system, the ledgers themselves. At its core, a ledger is really just a record keeper. The easiest way to think about it is like a dedicated digital notebook, where every single financial transaction gets written down. All those key reports you hear about, like the balance sheet and the income statement, they're all generated from what's recorded right here, in this ledger. Okay, so in a parallel system, we always start with the primary ledger. Think of this as the main notebook, the home version. It follows all the local laws of the land, what's often called local GAAP. This is the official record, the one that keeps the local tax authorities happy. And then, running right alongside it, you have the parallel ledger. This is our second notebook. It records the exact same transactions, but it applies a different set of rules, like IFRS, the International Financial Reporting Standards. This is the version that's needed for the global parent company, or for international investors who need to see everything in one consistent format. This slide shows that dynamic just perfectly. You've got the primary ledger on the left, keeping the local authority satisfied, and on the right, the parallel ledger gives you that global view. Now, the real magic happens with those adjustment postings. This is where the system accounts for the differences. For example, a piece of equipment might be valued one way under local rules, but a completely different way under international standards. The system just posts an adjustment for that difference, without ever changing the original transaction. It's pretty cool.
All right, that's enough of the theory. Let's walk through a really simple, practical example to see how this all clicks into place.
So let's meet the bike company. They operate internationally, and just like we've been talking about, they need to prepare financial statements using two totally different sets of accounting principles. And inside their accounting system, this is what it looks like. It's beautifully simple, really. They've got ledger 0L, which is all set up for their local accounting principles. That one generates all the reports they need for the local government. And at the exact same time, they're using ledger 2L, which is set up for IFRS principles. That allows them to create those consolidated reports for their parent company. So you get one transaction leading to two different but both correct outcomes all at once. So, what's the big takeaway here? Why is this system so incredibly important in the world of modern finance? Well, it all boils down to these key benefits. First, you're guaranteeing legal compliance everywhere you operate. At the same time, you're making group-level reporting for your parent company totally seamless. You can handle all the different valuation rules, and this is the most important part. You get all of this from a single source of data. There's no double entry, no reconciling two different systems. It's really the ultimate combination of being compliant and being efficient. This quote just sums it up perfectly. It's not about having two separate, clunky systems. It's about having one unified financial engine that is literally fluent in multiple financial languages. That can spit out a report for German tax law one minute and another for US investors the next, all from the same set of facts, without ever needing a translator. So parallel accounting really does elegantly solve a major hurdle of globalization. And it kind of makes you wonder, right? As business becomes even more real-time, more decentralized, what's the next big financial puzzle that technology is going to have to crack? Today, we're diving into a